Good afternoon. My name is Dawn McKnight, and I am the Executive Director for the Independent Association of Home Instead Franchisees. On behalf of the association, I would like to welcome you to our next session in our webinar series titled Your Path to Successful Wealth Management. This webinar is brought to you by one of our valued association vendor partners, Robert Stephen Capital Management. Just a few housekeeping items to share with you. Please put your questions in the chat, as we have saved plenty of time at the end of the webinar for questions and answers. I will also send a link out of the recording and a PDF copy of the slides by the end of the week to all of those who attended. Before I hand things over to our presenters, I'd like to share some information on the presenters and the company. Robert Stephen Capital Management is a fiduciary and SEC registered advisory firm with approximately $200 million in assets under their management. The firm has worked with several Home Instead franchise owners. Robert Morris is a former Home Instead multi-franchise owner of 9 years and successfully sold his franchises in December of 2022. Steve Streeter is the founder and principal owner of Robert Stephen Capital Management and has successfully advised clients for more than 25 years. Now I'm going to hand the presentation over to Robert.
Thank you, Dawn, and good morning and good afternoon to everyone on the webinar. I know we've got people spread out over the country, and so we really appreciate your time and joining us today, and thankful for the opportunity to be a vendor here with the association. Title of our webinar today is Your Path to Successful Wealth Management, and the specific reason for that being your path instead of a path is that we really feel that for that to be successful, it's about you. It's about your goals, your risk management, and all those types of things. And so we're going to talk a little bit about that today and how that really is tailored toward what would be a successful wealth management for you. As Dawn mentioned, Steve Streeter is here with me as well here today, and I'll introduce a little bit more about our firm. As Dawn said, we are an independent fiduciary wealth management firm. We're based in Tulsa, Oklahoma, a little over 200 million in assets that we have under management. And we are a registered investment advisory, established in 1997. And you may actually see the name, so the registration under Streeter, Morin Stipe, and we do business as Robert Stephen Capital. Steve is our founder and principal owner. We have 3 registered advisors within the firm and 3 administrative, and growing from there. And our real focus that we like to talk about with clients is that we are customer centric and really led by our clients' risk profile and their targeted goals. So it really is all about them. One item I'll mention, you may have heard the term fiduciary, and if you're not familiar with that, being somewhat of a legal term, that means that we invest our clients' resources as if they're our own, as if we took your resources and made them our own. And so therefore we must disclose any conflict of interest. We don't sell products or make commission on any of the products that we could have sold. And our compensation is based totally on a percentage of assets under management. So we increase our wealth by increasing your wealth. It's really about growing your assets. In that regard, as a fiduciary, we're legally bound and required by law to put our clients' interests first and disclose any conflicts of interest. This is our team here. So as I mentioned, we have 3 advisors and 3 administrative individuals. And then how we connected, how do we get here today? As Dawn mentioned, I had 9 great years as a senior care, Home Instead senior care franchise owner. I was also a member of the association. And so I've seen a lot of the conversations and things that you guys have been going through over these last months. We had 9 years as a Home Instead franchise, multi-franchise owner in Oklahoma City, and just a unique and fun time. Really believe in the business and the mission for what they do and what all the Hogans set out to do. We purchased our existing franchises in 2014 from Sue Loftus. She started that in '99, so she'd been there for 15 years, and we were very thankful to be able to take that over from her. And then I sold my franchises in December of this last year to Paul and Ashley Fry, and many of you may know them. Great people out of Arkansas. And we've really come to appreciate them and getting to know them over time. We did participate, as many of you did, in the payroll protection, the PPP loans, and we also participated in the employee retention tax credit. So understand what some of you have gone through or some of you are thinking about doing. We did use Synergy Partners for that, and be happy offline to talk more about how that process was. I've known Steve Streeter now for about a little over 25 years and joined the firm here in January of 2023, more to administrative business development role. So that's the connection and how we got to be here today. One disclosure I did want to read just from an SEC perspective to make sure we are in compliance. And I'll just read this to you so we have a matter of record that Robert Stephen Capital Management is a DBA of Streeter Moore and Stipe and is a registered investment advisory with the U.S. Securities and Exchange Commission. Information in this presentation is not intended as authoritative investment guidance or tax or legal advice. You should consult your attorney or tax advisor for guidance on your specific situation. In additional disclosures and information about the qualifications and business practices of Streeter Moore and Stipe is available on our website, which I show there, as well as on the SEC's website at advisorinfo.sec.gov. So just a matter of housekeeping to get that out of the way. So what are we going to cover today? As some of you may know, and some of you, I appreciate the feedback. We did get about 11 responses back on some surveys that would give us a little information about who we have in the webinar today. So we're going to cover a little bit of that. I think you'll find it a little bit interesting to see where you stand and where everyone else is, as you're all in the same boat as franchise owners. We're going to walk through 6 steps to your wealth management process and kind of what that might look like. I know that many of you are already working with advisors, and you can maybe compare to what your experience has been. Hopefully it's been something similar and positive. We'll talk a little bit about some types of investment risk, and then answer that question. Should I utilize an advisor? Maybe I can just do this on my own. Maybe some tips on how to decide which one. If I'm shopping for an advisor and trying to figure out what would be a great fit for what my goals are. A lot of encouragement, if you will, and coaching to get started and not wait. Time value of money and compounding interest has a big impact on that, and a big encouragement to start as early as you can. I do have a few tips on some cash flow management, specifically for home instead owners, having been one and now on this side in wealth management. And then we have a few polling questions and then regular Q&A. So we're excited about this opportunity. We'll kind of kickstart into it. A little bit of survey feedback. This just gives the age distribution there in the top left. And you can see that most of us are all getting older. I fit in the same area of, over 50, and most of us kind of move toward that. I would say it's representative probably of the group of, 40 or so that we have on here. Current investment portfolio, the responses we had were that most had anywhere from $500,000 or more currently in their investment portfolio. When they would anticipate needing investment funds, kind of pretty varied and spread. But I will say that, from probably 4 to over 10 years is kind of what that looks like, which is good, meaning you've got time to work on that and to grow it. Currently using an investment advisor, 7 that did respond in the yes, and 4 that said no, they were not currently using an advisor. A few of the other questions, just household income. I know this was an interesting one we always had in Performax. We put financials together and then go, well, where is all that money they say we're making? But household income came in that most were making, $200,000 or above. They were saving anywhere from 11 to more than 20%, which is great, meaning they're putting some money away. And then what was the most important decision factor for choosing your portfolio and investing your funds? Pretty well spread, but also pretty set on the safety of that investment principle. People were worried about, they didn't want to lose that principle. Last set of questions there. What was the approach to investing? Again, pretty spread there on more conservatives toward the top there, increasing investment while minimizing potential for loss, and then fairly evenly split toward the bottom there. Hey, we want to pursue investment growth, but we would accept moderate levels of risk and some fluctuation in the principal. From a liquidity event standpoint, I know this is an interesting one, just given all the events and things that have taken place over the last year or two, I guess, with new ownership and all, was, hey, if I were to be selling my business, when would I more than likely be looking to do that? And so the 11 respondents, we said There were 3 that, hey, maybe in the next 12 months, 1 in the next 2 to 3 years, and 7 said, 3 to more than 5 years before they would be looking to maybe sell their business. And then the last one there on the PPP, 7 said they'd received that. Only 1 said they got the ERTC only, and then 3 had done both. So steps to your path. What really we're talking about there is starting out with thinking through what is it you would like to achieve. So what are your goals from a financial perspective? And obviously that's going to vary and be different for all 40-something people we have on this webinar. But establishing those goals, and it may be anything from, hey, I want to start with paying off all my credit card debt. I need to save for my children's educational expenses coming up. Maybe I want to pay off my mortgage, and then again look at that to see, does it make sense financially to pay off your mortgage? What kind of interest rate are you paying there, and is that a good use of your funds? I want to put away enough money for retirement, so I want a stack of cash that helps me understand that I can pull from that in my retirement years, and I'm not going to run out of money. Legacy plan. There are those of us, especially from an element of faith, that maybe I want to give some of that money away to an organization or to my church or to my family, and so just understanding what that might look like. And then other things. Hey, I'd like to have that boat that I've always dreamed of, or hey, I want the bigger boat that I've always dreamed of. Was Gusto, I want the airplane. Whatever that might be. Obviously, your financial goals will differ according to what you're looking for. That step 2, though, is, well, where are you at currently? If we know kind of where we want to go, let's understand where are we at right now. So where are you at currently is the financial planning process. When we can, and when a client will allow us to, what we like to do is glean a lot of information from them. And I've listed several things on there that can be overwhelming when you start trying to pull all this information together, but just the minimums of walking through a budget to see where your money is going can obviously sometimes be eye-opening. And then looking into, what is my net worth right now? What do my portfolio statements look like? Where are all my expenses going? What am I trying to save? And then we have a confidential data questionnaire that we go through to kind of see, what does that financial planning process look like? And usually it's pretty eye-opening for someone when they go through that. Step 3, then after we've done that, is, well, what's your risk profile? And here again, everyone can be anywhere on that spectrum. And answering a series of questions, we try to help them identify their tolerance for risk, and then versus what's their desired returns. And in order to have that return, are they okay with the risk that would be associated with that? How about volatility? We'll talk about that more here in a moment, but am I okay with things going up and down in the market? Or is that going to keep me up at night and I can't sleep? What do you think about the economy? When do you anticipate needing funds? And just planning through that. We found that most people probably plan more, and if we did a poll here, I bet we'd find the same. Most of us have probably planned more for our summer vacation coming up this year, where we're going to stay, where we're going to go, what we're going to do. And we spent more time on that than we really did on, well, what's my financial plan and how am I going to get there? So anticipating when might I need these funds and what does that look like? Savings trend and future earning potential. So once we have that risk assessment and we've taken that information in, we score that, and you're going to end up somewhere on this particular risk spectrum. If you look more towards the left, maybe it's more fixed income, you have minimal risk that you're willing to take, all the way to the very far right, very high risk, and I want very, very aggressive growth. And then everything in between there, you may be more balanced, or for example, in my particular situation, I'm 52. I'd like to gain more from my assets. I'm willing to put a little more out there. I don't need those funds right now. I fall more into that high risk growth with some income. And so you'll kind of get slotted from a risk perspective as to where do you stand. Now, understanding investment risk, one of the principles of that is just understand that there's no such thing as a risk-free investment. Every investment has an element of risk that may take on a different aspect. For example, if I were to put it into treasury bills or money markets and feel like, well, that's all backed up by the government, it's virtually or almost risk-free, but there's inflation risk with that. The purchasing power might change with that. There's opportunity cost risk in that if I put that into those treasury bills, I lost the opportunity cost to maybe get greater value in some equity or private investment, whatever else I might have had. So there is no such thing as a risk-free investment. Investors seeking greater investment obviously must be willing to accept greater risk. That's just a natural thing with risk and investing. That risk can vary depending on how long the investor has to obtain their goal. Another one of the questions that we get into and really look at is, well, how long do you have to build a portfolio to get income from that portfolio before you're going to need those funds? And the longer you have, a little more risk that you can take. The shorter, maybe you can't take as much risk. Risk cannot be eliminated completely, but it can be managed. And through some careful planning, through monitoring, and some disciplined investment processes, we can help bring down that risk in that process. Now, let's say there's some types of risk. We talked about just the principal risk, and that was one of the items that a lot of you responded back with and said, hey, that's my biggest concern, is I don't want to lose my principal. So that's the principal risk of just having that, losing that. Volatility risk, we'll talk about here in a minute. Purchasing power, inflation, we've all felt that in the last few years as expenses have gone up and things just don't cost the same thing they used to, and then opportunity cost risk. When you look at volatility, it's really about what are you comfortable with? And so I've given you two examples here. On the left side there on scenario one, if you were to start with a $200,000 investment and with an even 5% annual return, so maybe we put that into money market or some CDs or something like that, and over a 20-year time period, you'd have a little over $500,000, right? So you've more than doubled your money within that 20-year time period. And you can kind of see that the trend curve on that's pretty slow upwards and to the right, and we don't have any downward losses in that particular segment. That may be what someone's volatility risk looks like, is I don't want any, right? I don't want to wake up the next day and see if the market's fallen 15% and what happened to my investments. And so that's going to freak me out. Maybe you're much more conservative and you need to see something that's just slowly growing over time and really doesn't change much. On the other side of that, scenario two, you could start with that same $200,000. And if we average a 12% annual return on most of those 20 years, but if in 5 of those years we had negative growth, so I had a year where I had 5%, maybe I lost 7% or 3%, maybe one of the years I lost 20%. As long as that would not just totally, freak me out from a standpoint of what happened to the market, I got to get out. Even with those negative years, with that average 12% annual return in the other years, in 20 years, I've got a lot more money, almost $200,000 more than I would in the same scenario, starting with the same amount of money and same amount of time. So just kind of showing you what are you comfortable with from a volatility standpoint. Step 4 here, I'm going to have Steve take over this here in just a minute, but really what we're talking about now is evaluating, once you've gone through, what am I trying to achieve? What are my goals? What is my risk profile? What am I comfortable with? Where am I at currently? All right, well, what options do I have? What are the things that I could invest into? And there are numerous ones. So I'm going to turn it over to Steve to talk on some of those items.
Hey, thanks, Robert. Can you hear me fine?
Yeah.
I'm muting it. Okay. Well, first off, if you guys have ever had a chance to meet Robert, I know some of you maybe have. We're really glad to have him on board here, and he's been a breath of fresh air in a lot of ways. But so thankful to have you. Robert wanted me to talk here a little bit about some of your options and where you can invest. Like if you've received extra cash from whether it was PPP or sell of your business or what have you, what are some good places to put that? And one of the things that is new, relatively new, it's not new, but it's a relatively new phenomenon. In the last 20 plus years or so, you really haven't been able to make much income on things like bonds or CDs, any deposits you might have had in a money market account, even even real estate, except for a few hot markets, has been pretty flat for decades. But in the last 6 months or so, as the Fed's been raising rates, there's a lot of opportunity right now to buy bonds that can pay nice interest rates, 4, 5, 6, 7% even, with relatively not much risk. In fact, right now, treasuries, if you were to look at short-term treasuries, we're getting over 5% on what is considered a risk-free investment. If there may be some opportunity to go ahead and lock in longer-term bonds and really take a lot of future uncertainty about your income off the table. So we've been helping a lot of people with that recently. And also with that, some of the other things that are needed to achieve your goals are where's my income coming from? Social Security, do you have future long-term care policies in place if needed? Do you have a pension with work, an old employer possibly, or what have you? Was there anything else, Robert, you wanted me to talk to in regards on that part?
No, the next one, I guess, just kind of, and then Steve was talking about how you might put together a portfolio and what that looks like from all the different various things that you can use. Right.
And so, one of the things that was mentioned earlier is inflation risk. And that's something that it's a hot topic right now. Inflation is, if you've been to the grocery store, you understand what that looks like. So in addition to bonds, which, again, interest rates are at all-time highs in the last 20 plus years. So not all-time highs, but you even though you have increased rates on your fixed income or bond portion of your portfolio, you're still going to need to invest in equities strategically with the idea that, if inflation is 6% and you're only making 5% on your bonds, how do you make up the difference? And one way we are still able to do that is through a managed portfolio of stocks, and found that to be very helpful. This next slide kind of talks about that. Do you want me to talk about that?
Go ahead.
Well, so these are just examples of, depending on how comfortable you are with risk, and we use a risk profile questionnaire to kind of help identify what you're comfortable with, what a portfolio might look like for you. Just a combination of bonds, equities, cash and cash equivalents. I mentioned earlier money markets. Our short-term money markets right now are paying almost 5% and gross. And then another piece of the pie are what we call alternatives. And alternatives can be a combination of real estate, natural resources, precious metals, like gold, for example. And also, alternative might be just an active strategy to help you identify risk and what might be working well in the market, or maybe using puts, options to maybe protect part of your portfolio, or to generate additional income through calls, things like that. Okay, is that good?
Yeah, the other thing I just mentioned on that, Steve, when we put these together, and want to make sure everyone understands, is each one of those pies, if you see a portfolio there, kind of attaches to the risk spectrum box above it. And so if you look over in the left, in that minimal risk, maybe in your fixed income, you've got 60% likely, this is just a sample, but likely you're 60% in bonds. As you moved over to the right, you'll see that peach color goes from 60 to 50 to 40, all the way down to 20. And so we're reallocating your portfolio based on the risk profile that you presented, based on this is what I'm comfortable with. And each of those does the same thing, from equities going from 20 to 50%. So you just have a good stool with 3 or 4 legs to it that provides stability within that portfolio.
Excellent. So one of the things we do here that's super important is, and Robert had mentioned this earlier, we're fiduciary advisor, which is a little different than now a lot of advisors are kind of moving towards this now because I think it makes the most sense for the relationship with the client. Basically, we try to vest our advice with you. In other words, what we're trying to do is help you accomplish your return goals and grow your account values, and then also minimize any potential account losses. Since our compensation is actually tied to the value of your account, we're incentivized, we believe, to maintain value or grow your account. So with that being said, we're going to be constantly communicating with you, reviewing periodically throughout the year your holdings in your account and how we manage that money. I see a couple of quotes here that are on the wall here in our office. It's kind of counter to most people's way of thinking, and that typically when you invest your money, you invest it when it feels good. And what we try to help people do is say, well, really when you want to invest money is when most people are fearful and when people are not wanting to be invested. And you're going to make the money when you make that purchase, not necessarily when you sell it. So we do a lot of maybe contrarian investing in a lot of ways, especially on stocks. Yeah, Shelby Calhoun Davis, he was kind of the Warren Buffett before Warren Buffett. A lot of the same principles that Warren Buffett uses are what Shelby Davis used, 75 years ago. Well, this is a great chart that I asked Robert to add in here. This is basically the NASDAQ composite in the last four, if you include our current time, the performance of the NASDAQ. And if any of you guys were investing in the market during these time periods, you may have experienced this, but the longest downtrend, which was the dot-com bubble or the tech bubble, began in 2000, ending October of 2002. And you can see that the NASDAQ was down almost 80% peak to trough. So imagine being an index investor and being invested in the NASDAQ passively or during this time period. Can you imagine $1 million account being worth 200,000? Most people would, if you had an advisor that said, hey, you just need to hold on and eventually it'll come back up, that wasn't a pleasant time. I'm sure you lost some sleep over that, but and a lot of people had to postpone their retirements because they really weren't actively managing their accounts through those downtimes. If you're taking distributions from your investments during a period like this, it can crater your best laid plans. So we've always felt like you can't just buy and hold and wait for the market to come back. If you invested a portion of your portfolio in the NASDAQ during this time frame, it might take 15 to 20 years to break back even on something like that, if you had happened to begin your investing before this downturn. The other one is the dark blue is a great financial crisis, which is, everybody talks about the 2008. Again, another time period where you're down 50%. The next slide is the S&P 500. So, Frank Bogle with Vanguard, and I'm totally, I understand a lot of what he preaches, but if you happen to have had a cash infusion before any of these time frames and you invested it, any portion of your portfolio in the S&P 500 index, this is what you experienced. You're down 50% in 2 of those time frames, which can be, like I said, can completely crater the best laid investment plan. So we don't believe that we believe that it's important to minimize your downside risk as much as possible. And maximize your portfolio in such a way that when the market's going down, that we can't completely avoid a downturn, but we can definitely help manage through it and minimize how much downside you experience.
So one of the questions that someone might be asking is, well, why utilize a fiduciary financial advisor, or why utilize a wealth management firm at all? Can I not just do this on my own? And obviously you can. Some of you may be successfully doing that now. There are some items with that, though, to help reduce conflict of interest. As we mentioned, as a fiduciary, Steve started this back in '97 that way, and a lot of firms have come around to that. You'll even see commercials of bigger firms that we'll talk about now. Hey, we're a fiduciary. And it's because it's putting them in the same driver's seat as their clients and saying, hey, if you win, we win. If you lose, we lose. And so that reduction in conflict of interest is a big part of why a fiduciary makes a lot of sense. Maximization of time. If you're a Homestead senior care owner, I can guarantee you have a lot going on with trying to find good employees. You're trying to hire people. You're out building your clientele in the market, keeping up with things going on with corporate. It's not usually something that's the first thing on your mind to say, well, what's the market doing today? And should I make some tweaks to my portfolio, right? Probably the last thing on your mind, and it's probably happenstance. So just maximizing your time and expertise and allowing a wealth management or a coach, if you will, to help you meet your goals. It brings peace of mind, right? I can sleep at night knowing someone's looking at it for me. Opportunities to invest, and I've become much more aware of that, even after joining Robert Stephen Capital, in that there's a whole network, if you will, of investment opportunities that were not even on my radar, didn't know about really. And I would have had to have dug and searched and probably happenstance found someone to say, hey, did you know about this investment opportunity? Wasn't aware of that. So it opens the door by having a wealth management firm in the know in those particular areas in that sphere. Mitigating risk, helping avoid emotionally based investing. And Steve was talking about this earlier. If you can remove the emotion from that, hey, the market's really going down. I think I better sell. I got to get out. That helps you make some quality decisions rather than just on emotions. And the market has shown that really we get hammered when we make decisions by emotions rather than what's really going on in the market. And taking opportunities. Last week, if you follow the market at all, I think it was last Tuesday or Wednesday was a down day in the market. There were some reports that came out, the market went down. There were some investments made. That was the time to buy because the market was down. And so taking advantage of those opportunities and then helping to manage the returns that you're looking to do. So if you decided, hey, I am looking to have a wealth management firm, what's the difference between firms, or is there any difference? The first one, if you've heard us today, is the fiduciary versus non-fiduciary. Is asking, hey, what type of firm are you? Well, not bashing any firms out there. There's a lot of good financial firms. There is a difference between fiduciary and non-fiduciary. And a non-fiduciary, likely, because they're compensated on commissions, are going to lean towards what makes them the most commission. And maybe making trades is what makes them commission. So you want to understand how they're making money off your financials. The minimum investment requirements. Typically, we have a $250,000 minimum investment requirement. Just because of both time and bandwidth, that's kind of what we look at, that number and above. Other firms that I'm aware of, they may have $1 million. If you don't have at least have $1 million, they're not going to visit with you, won't even take you on as a client. Now, we will do a financial plan that usually costs a couple $1,000s, and if we go through a plan, we'll then not have a minimum requirement. And so someone may be starting with less amount of money, but we've gone through a full financial plan with them and allowing them to see what their goals are and go through that. But if they just said, hey, I have this money I want to invest, then we have that minimum, and a lot of firms do. How they're compensated, we've kind of mentioned that before. Is it from growing your assets, or is it off the commissions and products they move you towards? The fee structure can also change. Typically, you're going to see an average of about 1% assets under management, or an AUM term used, but that also varies. If you had less than 500,000, that may be 1.5%. It may move to 1.25 from 500 to $1 million, and then go to 1% above $1 million. Some firms maybe 2%. So the fee structure can change, and you'll want to know more about how they're charging you fees. And that really comes into the transparency. Are they open about what they're doing? Is there good communication? Are we building a relationship? Or is it kind of, cloak and dagger? And if that's what's going on, it's not easy to develop a relationship and feel comfortable that I'm putting my money with someone who I trust and is going to work with me and communicate with me with what's going on. So what are some other questions you might want to ask? How about references and connections? Is this a firm that I'm aware of? Do I know someone, or don't know anyone there to make a difference? How will you communicate with me and with what frequency? And that varies from client to client. We have some clients that may say, look, I want an annual review once a year. Otherwise, I get my a monthly statement. You don't need to call me. I'm fine with that. Others who a little more frequently want to know, what are we doing? What are we changing? Here's a tweak. So what are you comfortable with, and with what frequency do you want to be communicated with becomes an important thing. We talked about how you're compensated. There's two items here I'll mention to you that if you're not familiar in the financial world that you may not know about, but checking out the firm's Form ADV, Part 2A on the SEC website. You'll see this, a link also on our website. Most financial advisors will all have this listed, a link that's basically a disclosure explaining who they are, what they do, and those types of things. So you want to check that out and find out, do they have any issues going on with the SEC and so forth. And then visitinvestor.gov is a free and simple search tool when you can research the firms, you can research the financial advisors and find out more about those professions. Why get started now? Or why should you have gotten started years ago, right? It's the time value of money. Now, I've created a few examples here, maybe oversimplification for you, but I just wanted to drive home the fact that getting started makes a difference. This particular example here, time value of money, the compounding interest, if you started with $500,000 and you invested it over 10 years at 7% interest, you're almost going to have $1 million over 10 years. You almost doubled your money. Okay. If I could get 2% more, if I could get a 9% return on that instead of 7%, now I've almost added $200,000 to that same initial investment over the same amount of time. And typically what you'll find, anywhere from 1.5% to 4% potential upside when you work with a professional who's helping you invest that money and monitor it with you. And there's a lot of studies over that. So that's why that kind of makes a difference. Is same investment, same time, but I may be $200,000 ahead sometimes with working with a professional. This one here, again, time value of money and getting started. Just a small $10,000 initial investment. If I added $2,000 a month, so $24,000 a year, but I was doing that, incrementally every month, $2,000, 7% interest over 30 years, I've almost got $2.5 million that I built up. So another great reason to get started as early as you can, even talking with your children and grandchildren, that why it's important to start early. This last example, I think, will hit home with a lot of us because it's right where I was. Okay. A year ago, 6 months ago, when I sold my business, a lot of you may be looking at, $1 million, $1.5 million, maybe it's a couple $1 million net. If you had a liquidity event, you sold your business. And this is, hey, I paid off debt, I paid off a broker, paid off any other additional fees, and I paid my taxes, and I've got $1 million or $1.5 million. What do I do with that? What, 7% interest? In 10 years, I would have almost doubled that money. Right? If I have 10 years to wait, I could get that almost to $3 million. If I had 5 more years to wait, now I'm looking at almost a little over $4 million. So it really matters on getting started early and just that compounding interest and the time value of money. I want to give you just a few tips, and I know most of you guys have been doing this for a long time and probably have some tips you could give me on it, but just a few items that if you're not already doing this. When we got into the home instead senior care business, one of the things that we inherited is we were accepting lots of checks from clients. Maybe it was a family member, maybe it was the client's spouse, or whatever it might be. They were, paying by check. And we quickly found out the difficulty of collections, or if a family member went on vacation and said, oh yeah, I forgot to, right, I'll be back in a couple of weeks and I'll get that check to you. And you're like, well, I still got to pay my caregivers. I've got to cash flow that. I better have working capital that can get me through that if I'm trying to collect checks for whatever reason, or maybe it's the VA. They don't always pay timely, And so if I'm having to wait on that, well, one of the things that we did was we quickly changed our process to a credit card and ACH payment only. I was fearful because there were some, I said, man, if I do this, I'm going to lose clients. You know, they're going to walk away from me. And so we grandfathered some in, but we put a hard line in the sand and we said every new client, it'll be ACH or credit card only. And it made a huge difference in our business from a cash flow perspective. We didn't have to have as high working capital needs because we were getting the working capital in. The second thing I'd recommend to you, and some of you are probably already doing this, if not, I'd at least recommend you consider, if you're not using PayPlus's payroll system, which when we first started, we were not. We used ADP, I used Paycom, but both of those financial systems, those payroll systems required that they took my money out of my account 2 days before payroll, which again was another drain on my cash flow. And when we moved to PayPlus, all of a sudden I was like, wow, they only took the payroll amount the day of payroll, and they gave me 2 extra business days. And so that hit a weekend, maybe it was 4 or 5 days before they took the money out for taxes. And so for us as a small business, it's a huge, really kick again for working capital. The third thing I'll add is what we learned as I kind of came on here with Robert Stephen Capital is the opportunity to maybe even consider a capital account and the option it gives for your operating account. If you have, say it's $200,000, $300,000, $400,000 sitting in a checking account that you're using, you're operating out of, and you're doing your payroll and paying your bills, and then you fill it back up again and so forth. But you're probably getting 1% at best, maybe less out of that checking account. We found that with some small businesses that we work with, we can move them over to a capital account and set them up with their operating account and their checking account linked. And basically you can have the same bill pay features, but get a much higher interest rate. We're probably talking anywhere close to, I think we're today in the 4.9% gross. And that's fully daily liquid funds that you could be getting interest on versus having in a checking account and getting, barely 1. So just some items to be thinking about from a cash flow perspective. As we kind of round things up, we have a couple of polling questions we wanted to get started with the group, and then we'll also open up to Q&A. But Donna, I'll kind of turn it over to you, see if we had some chat questions before the polling questions.
I do have one. Okay, so do you use stop loss, trailing stop loss, or a buy and hold tactic? I hope you know what that means.
Steve, you want to address that?
Yeah, I was trying to find the unmute button. Well, that's kind of on an individual basis, we can use stop losses. We're not buy and hold only. The only time we hold is when we feel like what we're holding is doing well, showing strength, is passing our filters. But even then, if we're experiencing any kind of market downturn like we experienced last year or in other downturns, as we showed on one of the slides back, I mean, we're going to move out of that security. But if you had a specific security in your account that you said, hey, I'd like to have some kind of downside protection on this, in our discussions, and we could definitely put one in place on a specific holding.
All right, thanks for that. You want me to go ahead and do some poll questions?
Sure.
All right. So can you guys see the poll?
Mm-hmm.
Okay.
Yeah.
I'll give everybody a few minutes. I've got about maybe half the people answered so far. All right, I'm not seeing any more responses coming in, so I'm going to go ahead and share the results. Can you guys all see the results?
Yeah. I'll make a few comments and Steve may as well, but I think it's interesting. It looks like we had 8 people respond. 6 of the 8 said yes, they have a current will, last testament, and 2 said no. To be honest with you, I recently in the past felt somewhere in between. So we had, children 23 years ago, and put together a will and had that in place. And there were 7 years between my oldest and my youngest, and failed as life got busy to update that. And so those were things that were important about, hey, I don't have my second child in my will. So just an encouragement to think about putting that together, having that in place. And it's obviously beneficial for you, but beneficial for your family, and just what they may be going through at some time if they were to experience that loss.
All right. I'm the same boat that you are. All righty, let's see. I'm going to launch the second poll. All right, looks like I've just about gotten everybody. So I'm gonna go ahead and share the results.
Steve, would you want to speak to that a little bit, of just around where we see the need for trust, and any maybe triggers for when it's needed and when it's not needed?
Yeah, I mean, so I'm trying to think the best way to address that, but when it does make a lot of sense to have a trust set up in a lot of cases, but not always. Trusts are nice in that it provides some privacy if you're to pass away, and it's a lot like a will in the sense you're predetermining how you want your assets, where you want them to go, and divide it up and such. And it does provide the fact that it's not subject to probate for any assets that are held in trust. But what I see a lot of times is people will set up a trust. They never actually move any of their assets or accounts into the trust. So it's just one of those things. It's important to kind of review and go through with someone, because it really doesn't, even if you have a trust set up and it doesn't own any assets, it doesn't really accomplish anything. So a trust does help in some potential guardianship issues, things like that, which you can also do with a will. But the nice thing about a trust is it allows somebody like us to help manage the money if both, if we're talking about children, if something were to happen to children, God forbid, and you both pass away, parents pass away at the same time, it's super helpful for that.
All right, that's good. So does that mean if it stays out of probate, so it saves time probably for the family, right? And maybe some emotions, because it's protected. It's not like they have to go through the courts to get the money. Does it make it more streamlined?
It can, and but you can, again, this is just things you kind of have to figure out what's best for you, but you can also accomplish the same thing with an account where you maybe have a transfer on death or payable on death provision for an individual account. There are some tax reasons to not always own things jointly. Things that are owned jointly with right of survivorship work well. Also, it automatically goes to the surviving spouse, and by avoiding probate. Anytime assets have to go to probate, it becomes public at that point in time. So you can accomplish a lot of the privacy things, not just with a trust. It just depends on what your goals are.
Mm-hmm. Okay. All right. I'm going to go ahead and launch the last poll. Well, people are answering it there. I do see a comment in the chat. It says, we have a young child, so we had to set up a trust to make plans.
Yeah, I would agree that that's where trust can really make a difference. If you have a young child or children, or even adult children, that you may not want to give them all that you've saved or set aside at one time, and kind of maybe space it out over time. You can do that with a trust. Fantastic. Yes, exactly. Teen boy getting lots of cash, not a good idea. Typically,
All right.
yes.
I went ahead and shared the results. Now for anybody that answered, so the two people that answered other, because Zoom doesn't allow a text box, if you have something in mind and you don't mind putting it in the chat, another area that you'd like to, learn about, go ahead and do that so we can capture that.
Hey, Don, I would add that one of the reasons we wanted to do this specific poll is that one of our desires here at Robert Stephen Capital, and for Steve and I, is to really be a resource to the association members. And so while this is our initial webinar, if interest is there, we anticipate potentially doing another webinar or two later in the year. And we'd really like to be able to dive deep into something that people are interested in, whether that's the hot topic or a bigger poll that said, majority of our owners have this issue. Can we dive deep just into that specific issue? And so that's kind of what we're looking at here a little bit, and get some more information from it.
Absolutely.
It's almost equal interest across the board, but
yeah.
So we invest in all these things at different times, stocks and equities, or as they have been. It's really been one of the better places to be invested for yield, even in the last few years. Managing the risk that comes with investing in stocks, bonds. We talked a little bit about that earlier. I mean, bonds are definitely have the best yield they've had in a long time, and start to make a lot of sense from that perspective. ETFs is just another way to invest in stocks and bonds through like a chassis, a lot like a mutual fund, but it's traded intraday, so it trades like a stock or a bond, whereas mutual funds, you can't really trade them throughout the day. It's just, if you do buy or sell, you get whatever the price is at the end of the day in a mutual fund. There, talk about you talk about I bonds. Sure, I bonds are good. You're limited to, I believe, $10,000 per spouse, and it has a nice, right now the yield's good on that for the first year. It's going to reset after that, but we definitely see in some cases where that can be helpful. It's just they limit how much you can invest, so sometimes it's a bit of a challenge for people. We can't do that for you. You have to go out on your own and buy those directly from the Treasury.
All right, and I think everything else was here. So, so did you see from Stephanie possibly something about selling? Is that something that you guys could take a deeper dive on, or is that
Selling your business?
I'm guessing, yeah, I'm assuming selling the franchise.
Absolutely. If you got, that's, Robert was dealing with that a year ago, and some other owners that we've worked with that have sold their businesses, and we just kind of, I mean, we can spend a lot of time on that, but we definitely have, can help with, if you want to call us afterwards, Robert can address some of your questions. That might be best way to handle that.
Yeah, do you want to put your maybe your email addresses or the phone number of the firm in the chat? And then I can also send it out to everybody when I send out the recording.
Yeah, this next slide here, I don't know if the poll goes away there.
Yeah, you still see the poll? I did close it down.
Okay, so there's some follow-up, both an email, office and cell numbers for anyone who wants to write that down, and feel free to reach out. Be happy to answer any questions related to not only what we talked about today, but anything other financial, give perspective on, what's it like on the other side after sale? What did we go through, and some of the things to be thinking about. I know we had 2 or 3 people that mentioned that, within the next 12 months, they were thinking of selling their business. And I know what I found, and through some other owners at Home Instead that I know that even took longer than mine, that it can take a lot longer than you might think. And you may be wrapped up in that business for quite some time in the sales process, even after you close. So it's something to be thinking about that doesn't necessarily happen extremely quick. When you have 3 parties or sometimes 4 parties, if you have a broker involved, you have a buyer, yourself, and you have corporate, right? So you've got to have all these parties on the same page and working in conjunction to make that sale happen. And so be happy to entertain and talk about that to help people out as well. Any other chat questions there, Don?
No, I don't. Somebody asked for their website, your website. So I went ahead and put that in the chat already.
Okay.
You talked about, I think that's it.
Well, we very much appreciate, the opportunity to present today, and like I said earlier, we really want to be a resource to the association members. So feel free to reach out if it's something you're not even sure what to ask. We'd be happy to have the conversation and talk you through that. We're always in the process, obviously, of taking on new clients, and if that we meet the right criteria for them and they for us, and we're happy to entertain and talk with them on that as well.
That's great. Well, as part of the association, we truly appreciate that, right? I mean, what a great resource, especially because you walked in everybody's shoes, Robert, by, being an owner, working in the business and the industry for all these years. You sold your business. And so just a wealth of experience, that you can impart on everybody. So, well, great. Well, I don't see any more questions. So I just want to thank Robert and Steve for your time this afternoon, and and the time you spent preparing for the webinar, the survey we put together. And I know we're going to do some more webinars later in the year. We'll figure out a topic or two and be able to take that deeper dive with members and really provide them with some additional benefits. So thanks for that. And I want to thank everybody else who attended today. Hope everybody has a great rest of your day, and I'll be sending out the recording and a PDF of the slides by close of business on Friday. So thanks, everybody.
Thanks, Don. Appreciate it, everybody.
Take care.
Thanks, Don.
Yep. Bye-bye.